The market's surface and the depths of demand, we observe a curious tension in the market's current dance. A visible surge of capital into new instruments, yet a quiet whisper from the underlying structure, suggesting fragility. This is the market revealing its dual nature, a mirror reflecting both our hopes and our hidden anxieties. You see the numbers, don't you? Bitcoin ascending past $72,000. The headlines speak of institutional inflows, of hundreds of millions flowing into spot ETFs, extending a streak of what appears to be unwavering demand. Over 2 weeks, nearly $1.50 billion has found its way into these new conduits, a sharp reversal from earlier periods of withdrawal. This influx, totaling over $1.70 billion since late February, seems to paint a picture of renewed confidence, of a market finding its footing, perhaps even a new floor. But what if the surface tells only part of the story? What if the very mechanisms designed to bring clarity also obscure the truth? We must look beyond the immediate figures, beyond the simple act of capital moving from one ledger to another, for what is truly being expressed here. Is it conviction or merely the echo of a new arbitrage opportunity? The market, in its infinite complexity, rarely offers simple answers. It demands that we interrogate the nature of the action itself. Consider the architecture of these new instruments, these spot ETFs. They are designed to bridge the gap between traditional finance and the nascent world of digital scarcity. Yet, in this bridging, a subtle distortion can occur. Analysts have cautioned us, reminding us that an inflow into an ETF does not always translate into immediate direct buying pressure on the spot market. The authorized participants, those who facilitate the creation and redemption of ETF shares, possess a flexibility. They can create shares and even short them before they source the underlying Bitcoin. This is not a flaw. It is a feature of market making, a mechanism that provides liquidity. But it also means that the initial demand you perceive through ETF inflows might be a synthetic demand, a promise of future action, rather than an immediate, direct acquisition of the asset itself. This delay, this layer of abstraction is critical. It introduces a temporal disconnect between the reported inflow and the actual impact on Bitcoin's price discovery. It allows for a period where the market can appear robust, fueled by institutional interest, while the true underlying demand for the physical asset remains in a state of anticipation. It is a subtle form of monetary illusion, where the proxy is mistaken for the genuine article, at least for a time. We are observing the market's memory being tested, its ability to discern between genuine accumulation and the transient movements of capital, seeking yield or hedging exposure. Yet, amidst this complexity, there's a deeper truth emerging, one that transcends the immediate mechanics of ETF flow. The resilience of Bitcoin, even in the face of geopolitical tensions, speaks volumes. It suggests a reevaluation, a shift in perception. No longer is Bitcoin seen merely as a risk asset, a speculative play, tied to the whims of the broader market. It is increasingly being understood as a geopolitical hedge. You see, unlike gold, which carries the weight of centuries of tradition and the limitations of physical custody and slow transfer, Bitcoin operates without pause. It is a 24/7, borderless ledger capable of moving value across continents with the speed of light. This makes it a natural escape valve for capital, a sanctuary for those seeking to preserve their wealth from the erosion of inflation, the uncertainty of state control, or the sudden shocks of global instability. It is a reflection of human action seeking sovereignty, seeking an exit from systems that are increasingly fragile and prone to intervention. This is not just a narrative. It is a deduction born from the very principles of scarcity and human preference. But what of the underlying signal? The market, like a living organism, breathes and exhales. And while the institutional breath appears strong, there are whispers of fragility from its core. Glassnode, a keen observer of the market's internal rhythms, points to a weakening in buy-side momentum. The 30-day moving average of realized profit, a measure of how much profit investors are actually taking, has fallen significantly since early February. This suggests that while new money might be entering, the existing holders are not seeing the same robust, sustained upward pressure that would encourage further accumulation. The share of Bitcoin supply held in profit has also slipped, now resting at around 57%. Historically, such levels have been associated with the early stages of deeper market corrections, even bear market conditions. This is the market's memory speaking to us, reminding us that past patterns often echo in the present. It is a signal that the easy gains may have been harvested, and the path forward requires a more discerning eye. Consider the short-term holders, those who entered the market more recently, perhaps chasing the momentum of the past few months. Their average cost basis, the price at which they acquired their Bitcoin, hovers near $70,000. This level for them becomes a psychological threshold, a behavioral ceiling. As the price approaches this point, it can trigger a wave of selling as these short-term holders seek to exit their positions at or near break-even. Rallies in such an environment can quickly transform into distribution zones, where the enthusiasm of new buyers is met by the quiet, determined selling of those looking to minimize their losses or simply get it. Are we witnessing genuine conviction or merely the echo of past cycles amplified by new instruments? The market is a complex interplay of human psychology, of fear and greed, of rational calculation and impulsive action. These inflows, while significant, must be understood within this broader context. They are a testament to Bitcoin's growing relevance, yes, but also a reminder of the layers of abstraction and the potential for illusion that can exist within financial markets. Bitcoin, in its purest form, remains a singular solution, a decentralized, immutable ledger, a true store of value, and the only reliable cryptocurrency. It is the antithesis of the credit expansion and monetary illusion that pervades the legacy system. When we speak of Bitcoin, we speak of individual sovereignty, of a return to sound money, of a time preference that values the future over the fleeting present. The question, then, is not merely how much capital flows into these new vehicles. The deeper question is, what does this capital truly seek? Is it genuine freedom from the distortions of the existing system? Or is it merely seeking another avenue for speculative gain within that very system? The market, in its ceaseless unfolding, will reveal the answer. We are blocksonic. We don't predict the market. We read its memory. Never forget, Bitcoin is only yours in your cold wallet.